Hello, this is Rafael Jose, and I'm a licensed real estate broker with the state of New York. What I'm going to have a conversation about right now is something that's on people's mind and it's all over the news. It's actually a reality if you're getting a pre-approval, okay? And that's interest rates, specifically mortgage interest rates. Now, we've been very comfortable at 3s. I remember in 2020, even in the 2s. Now approaching 5%. And this is the reality. It spiked all of a sudden. And there's a few reasons for that. Number one, the reason why we had very low interest rates for the past 2 years is because we have an entity called the Federal Reserve, and they have actually been purchasing 1/3 of the mortgage bonds. So I don't know if you know, a lot of the mortgages, the majority of the mortgages are packaged and sold as bonds. In the secondary market, investors buy them. So what's been happening during the pandemic is that the Federal Reserve artificially created more money, currency, in order to purchase 1/3 of the mortgage bonds. So they were creating the market for that in order to bring interest rates down. And this is why we had these rates. And they also promoted to the market that there was no inflation. So therefore, investors were not demanding higher rates. Well, all that is over right now, and the reason is that we have very high inflation. It's finally crept in because of all the money in circulation. As a matter of fact, I believe it was $7 trillion that was introduced during the pandemic. So at this point, an inflation issue is a very big problem, and they have to tame. The accommodations from the Federal Reserve have completely gone away, so they're not buying it. So it's up to the market to determine the interest rates now. And what investors are doing is they're asking for more returns. So CPI was around, Consumer Price Index, which measures the inflation, was around 7 to 8%. That means that's feeding into your buying power. So at the end of the day, investors are demanding more. Now that the Fed is not there, expect rates to continue to increase. Okay, right now they should be hovering on 5%. And they're probably going to go much higher because, like I mentioned, investors are going to demand more. In addition, the Federal Reserve is going to increase the Fed funds rate, and this is the overnight borrowing rate for banks. They're going to increase. They increase it to 1/4. They may increase it to 0.5 basis point, 0.5, and that will affect interest rates also. One of the things that you can actually track is the 10-year Treasury yield interest rates. And that kind of coincides with the mortgage interest rates, and that's basically, basically the bonds on government bonds for a 10-year duration, and they've been creeping up. Right now, there's about a 2.4 relative to 2020, where it was like 0.5. So that is continuing to go up. We just have to make adjustments. You have to understand that this is the new environment that we are in. It's actually a natural environment. The market is working the way it's supposed to be, not artificially. Okay, so hopefully that helped. I wanted to get this out there because there's a lot of confusion about interest rates and what's happening and that type of stuff. So if you have any questions, you can always reach out to me and I'll answer back, okay?